Welcome to the deep dive. Today, we're tackling something really crucial if you're involved in commercial real estate or even just thinking about it. We're talking about the internal rate of return, usually just called IRR.
That's right.
And we're working from a source called In-Depth Guide to Internal Rate of Return, IRR, by Kara Conde. It's dated April 20th, 2025. Our mission today really is to get a solid handle on what IRR is, why it's so important for commercial properties, how you even calculate it.
hmm And its uses, advantages, but also its limitations, which is key.
Exactly. And hopefully figure out what makes a good IRR. The goal is for you, our listeners, to see if this metric can help you judge if a potential deal aligns with your own financial plans.
Precisely. Think of it as a powerful lens to view investment potential.
Okay, so let's dive right in. The guide defines IRR as the discount rate that makes the net present value NPV of all cash flows equal to zero. Now, for those of us maybe not deep in finance daily, what does that really mean for, say, an office building or a retail center?
All right, let's break that down. Imagine you buy a property. You put money down initially,
It's
right?
like a purchase price.
Exactly. Then, ideally, you get rent money coming in over the years, and eventually you sell it. IRR is basically the single annualized percentage return you're earning on your invested money over that whole time you own it. What makes it smart is it understands that a dollar today is, well, more useful than a dollar you get next year or 5 years from now, the time value of money.
Ah, okay. So it accounts for when you get the money, not just how much.
Precisely. Commercial real estate deals play out over long periods. You have rent, expenses, maybe refinancing the final sale. IRR pulls all that together into one yearly return figure.
So it sounds much more sophisticated than just looking at, say, return on investment or ROI. The guide compares IRR to a few other metrics. Why is IRR often preferred?
Good question. ROI, well, tells you your total profit percentage, but ignores when that profit happened. A quick flip versus a 10-year hold could have the same ROI, but feel very different.
Yeah.
Then you have the equity multiple. That tells you how many times your initial equity you got back in cash. Useful, but again, no sense of time or annual return.
And cap rate. That one comes up a lot.
Yeah, cap rate is important, but it's just a snapshot. It looks at 1 year's net income relative to the property's value right now. It misses the long-term picture, future rent growth, the eventual sale.
So IRR handles those different timelines better.
Exactly. It lets you compare, say, a stable, maybe lower return retail property that pays out steadily with maybe a riskier industrial development project that might have bigger payouts later. It puts them on a more level playing field.
And the source mentions Karakondi using this across different Indianapolis neighborhoods, from established ones like Meridian Kessler to up-and-coming areas like Fountain Square. Shows its versatility, I guess.
It really does. It adapts to different investment strategies and property types.
Okay, let's dig into how it works a bit more. That time value of money concept is central, isn't it?
Absolutely fundamental. Think of it simply. If you have a dollar today, you can invest it and potentially have more than a dollar tomorrow.
For opportunity cost.
Exactly. So money received sooner is inherently more valuable. IRR recognizes this. It calculates the specific discount rate. Think of it like an interest rate that takes all those future expected cash inflows, rent, sale proceeds, and discounts them back to their value today. When the sum of all those discounted future cash flows perfectly balances out your initial investment, the discount rate used to achieve that balance is your IRR.
Okay, so it's the rate that makes the present value of the future money equal the present cost.
You got it. That's the core idea. It's finding the effective annual rate of return embedded in the deal's cash flows over time.
So what are the key ingredients we need to calculate this IRR? The source lists a few components.
Yeah, there are three main things you absolutely need. First, the initial investment. And be thorough, not just the purchase price, but closing costs, immediate repair costs, everything up front.
Got it. All the cash going out at the start.
Second, you need the projected cash flows over the life of the investment. This is the tricky part, estimating net operating income, rent minus expenses, year by year, and crucially, what you think you'll get when you sell it.
Projections can be tough.
They can be. And third, you need the holding period. Are you planning to own this for 3 years, 5 years, 10 years? That time frame massively impacts the IRR calculation.
The guide gives a practical example. A $1 million office building, downtown Indianapolis. It makes $100,000 a year in net cash flow for 5 years, then sells for $1.5 million. How does IRR help us understand this deal?
Okay, so IRR takes that initial outflow, the $1 million, then looks at the inflows. $100,000 each year for 5 years, plus that final big inflow of $1.5 million from the sale in year 5.
Right.
The IRR calculation finds the single annual percentage rate that makes the present value of all those future inflows exactly equal to the $1 million you spent initially. It essentially tells you, based on these numbers, this investment is performing as if you earned X% per year on your $1 million considering when all the money moved.
And I guess having accurate projections for that rent and sale price is where local market knowledge, like the source attributes to Karakonde and Indy, becomes really vital.
Absolutely critical. Garbage in, garbage out, as they say. Good projections rely on understanding local trends, vacancy rates, comparable sales, negotiation skill, all of it.
Makes sense. Okay, the math. The source shows the NPV formula. NPV, it looks a bit intense. How do people actually do this calculation in the real world?
Yeah, nobody's doing that formula by hand with trial and error, thankfully. That's the theory. In practice, as the guide points out, you use tools. The most common is probably Microsoft Excel. It has a built-in IRR function that does the heavy lifting.
Okay, Excel, that's accessible.
Very. Or people use specialized financial calculators like the classic HP12C or similar models. They're designed for exactly these kinds of time value of money calculations.
And the guide walks through the Excel example for that $1 million office building. Could you quickly outline those steps?
Sure. In Excel, you'd set up a column with your cash flows, year by year. Year 0, that's your initial investment, so you'd enter number $1 million negative because it's cash out.
Okay.
Year 1, $100,000 positive, cash in. Yeah. Year 2, $100,000. Year 3, $100,000. Year 4, $100,000. Year 5. Now here you have the rent plus the sale proceeds, so $100,000 plus $1,500,000 equals $1,600,000.
Ah, combine them in the final year.
Right. So you have this list of numbers, maybe in cells A1 to A6. You just type IRR A1.A6 into another cell, hit enter. And as the source states for this specific example, Excel spits out about 15.24%. That's your IRR.
That seems straightforward enough with the right tool, but the guide mentions challenges too. What makes IRR calculation tricky sometimes?
Well, one issue is with irregular cash flows. If you have years with negative cash flow after the initial investment, maybe due to major repairs or vacancies, you can sometimes get multiple possible IRR results. That makes it ambiguous.
Multiple answers. How do you handle that?
It requires more advanced analysis, maybe looking at other metrics like modified IRR, ARR, or MIRR, or just being very cautious. The other big challenge, we keep coming back to it, is the accuracy of those cash flow projections.
Here, garbage in, garbage out again.
Exactly.
Yeah.
If your rent growth estimates or your final sale price guess are way off, your IRR number won't mean much. That's why relying on solid market data and expertise, like the guide mentions with Karakonde collaborating with financial experts, is so crucial.
Okay, so assuming we have a reasonably calculated IRR, how is it actually used day to day in commercial real estate? What are its main jobs?
It wears a few different hats. First, basic viability assessment. Does this potential deal meet my minimum required return? Investors usually have a hurdle rate.
Like a minimum bar to clear.
Precisely. If your hurdle rate is, say, 15% and the projected IRR is 18%, then, okay, it passes that initial screen. If it's 12%, maybe not. Second, it's fantastic for comparing different opportunities. That retail versus industrial example again. IRR gives you a common benchmark to compare deals with very different risk profiles and cash flow timings, apples to apples or closer to it.
Makes sense.
Third, scenario analysis. What if rents are lower? What if interest rates go up? What if I sell a year earlier? You can plug in different assumptions and see how the IRR changes. It helps understand the risks and potential upsides.
Testing the what-ifs.
Exactly. And finally, it aids in decision-making. Should I buy this property? Should I sell the one I own? Should I spend money on renovations? Will that boost the IRR enough to be worthwhile?
The source provides a case study, Kara, advising on a retail property in Fishers, Indiana. What did that illustrate?
That was a neat example. By negotiating better lease terms and finding a solid long-term tenant, the projected IRR apparently jumped from 12% to 16%.
Wow, that's a significant jump.
It is. And that 16% IRR provided a clear financial reason for the client to hold the property instead of selling. It showed how good management and negotiation directly impact the expected return, measured by IRR.
That really highlights its practical value. Okay, let's talk advantages. What are the biggest strengths of using IRR?
Well, as we've sort of touched on, its biggest strength is being comprehensive. It considers all the cash flows over the entire holding period and crucially incorporates the time value of money. It's a holistic view.
Unlike cap rate or simple ROI.
Right. Second, it's highly comparative. It gives you that single percentage figure that allows you to line up different kinds of deals side by side. And third, it provides an annualized return. People generally understand thinking in terms of yearly percentages, so it's quite intuitive once you grasp the concept. The guide notes this helps pros like Karakonde quickly sift through deals in Indy to find the ones with the highest potential return for clients.
Okay, those are strong points. But no metric is perfect. The guide is clear about limitations too. What are the main caveats we need to keep in mind?
Very important point. First is the reinvestment assumption. IRR inherently assumes that any positive cash flow you receive during the holding period, like monthly rent, gets reinvested and earns that same IRR rate until the end of the project.
Which might not be realistic, right? Finding another deal with the exact same high IRR for that rent money might be tough.
Exactly. It can sometimes overstate the true return, especially for very high IRR projects. Second, as we keep saying, it's highly sensitive to projection accuracy. Small errors in estimating future income or expenses can lead to big swings in the calculated IRR.
Okay, what else?
It ignores the scale of the investment. A 20% IRR on a $100,000 investment generates far fewer actual dollars than a 15% IRR on a $10 million investment. IRR tells you the rate, not the total profit magnitude.
Good point. Bigger isn't always reflected in the percentage.
Right. Also, IRR itself doesn't directly account for risk. Two projects might have the same projected IRR, but one could be far riskier due to location, tenant quality, market volatility, etc. You need separate risk analysis.
And you mentioned the multiple IRRs issue with weird cash flows.
Yes, that can crop up in complex deals and cause confusion. So the guide emphasizes that thorough due diligence and risk assessment, like Karakonde performs in Indianapolis, are essential to use IRR wisely and not be misled by its limitations.
So use it, but use it carefully and with other tools. Now, the million-dollar question, or maybe the multi-million-dollar question in commercial real estate, what is a good IRR? The guide suggests 15–20% is often strong, but it varies wildly, doesn't it?
It absolutely does. That 15–20% is a common benchmark you hear, maybe for moderately risky value-add type projects, but good really depends.
On what factors mainly?
Several things. Location is huge. The source uses Indianapolis examples. A stable property downtown might be graded 12–15% IRR because it's perceived as lower risk. But maybe an investment in a faster-growing but less proven suburb like Westfield might need to promise 18–22% or more to attract capital for the higher perceived risk.
Okay, location risk reward.
Then property type. Stable, long-lease industrial might have different IRR expectations than, say, a hotel or a speculative office development. Retail might be somewhere in between. The guide gives ranges like 14–18% for retail, 12–16% office, 16–20% industrial as typical targets. But these shift.
And the overall market?
Definitely. Market conditions matter. If interest rates are high, borrowing costs are up, so the IRR buyer's demand might also go up to compensate. Or if the economy is booming, maybe they accept slightly lower IRRs because growth seems easier. Even the financing terms you get on your loan directly impact your cash flows and thus your IRR.
And it's not just about the property or the market, right? The investor's own situation matters too.
Hugely important. Your personal risk tolerance is key. Are you conservative, looking for steady income? A lower IRR, maybe 12% on a very safe asset, might be perfectly good for you.
Versus someone aggressive chasing higher growth.
Right. An aggressive investor might target 20% plus IRRs and be willing to take on development risk or turnaround challenges. Also, your investment horizon. If you plan to hold for 20 years, maybe a slightly lower, stable IRR is fine compared to a shorter-term flip, where you need a higher IRR to justify the quicker cycle.
So it's very personalized.
It really is. And that's where, as the guide suggests, someone like Karakonde can help align the IRR expectations with a specific client's goals and the realities of the current Indianapolis market.
That makes a lot of sense. The guide also had that People Also Ask section, tackling common questions. We already hit the IRR versus ROI difference pretty well. It emphasized IRR's focus on timing and annualization.
Yeah, just reinforce that ROI is total profit, IRR is the annualized rate, considering when you got that profit. The example of the $1 a property selling for $1.05 after 5 years drives it home. 50% ROI is fixed, but the IRR could vary significantly depending on the yearly cash flows during those 5 years.
And the question about how to calculate IRR for real estate.
The takeaway there was, yes, use Excel or a financial calculator. Don't try it by hand. But more importantly, the quality of the calculation depends entirely on the quality of the cash flow projections.
So get help with the projections if needed.
Exactly. Especially in a specific market like Indianapolis, leveraging local expertise like Cara Conde's for those projections is recommended for accuracy.
And it revisited the what's a good IRR question, giving some indie-specific ranges. What were those again?
It suggested maybe 12%, 15% for prime, stable areas in Indianapolis, potentially reflecting lower risk. But for value-add deals where you're taking on more risk to improve a property, investors might be looking for IRRs over 20%.
But always check current market benchmarks.
Absolutely, those numbers shift. Consulting a local pro like Cara for current expectations in specific indie submarkets is the advice.
Okay, moving towards wrapping up. The guide offered tips for maximizing IRR. What were the key levers an investor can pull?
Several good ones. First, back to accurate projections. Solid research, realistic assumptions based on data. Cara's indie expertise was highlighted here again.
Makes sense. Plan well.
Second, effective asset management. Once you own it, you need to maximize rent, good leasing, minimizing vacancy, and control expenses. Smart maintenance, efficient operations. Every dollar saved or earned boosts cash flow and IRR,
Day-to-day blocking and tackling?
pretty much. Third, strategic financing. Getting the best possible loan terms, lower interest rate, maybe an interest-only period can significantly improve your IRR because it affects your cash outflows. Cara's lender network in Indy was mentioned as a plus.
Good financing helps a lot.
Fourth, market timing. Easier said than done, but buying in areas poised for growth or selling when demand is peaking can dramatically impact your entry and exit prices and thus your IRR. Requires real market insight.
Like Kara's, the source implies.
Right. And finally, risk management. Diversifying, doing thorough due diligence on the property and tenants, protecting your downside helps ensure you actually achieve something close to your projected IRR.
So it's a mix of good forecasting, smart operations, favorable financing, market awareness, and careful risk control. The source then really focused on why someone might work with Kara Condi specifically in Indianapolis. What were the main points?
It emphasized her long experience, 20-plus years, specifically in indie commercial real estate. Her certifications in negotiation and luxury marketing were noted, suggesting skill in deal-making and handling valuable assets.
Okay. Experience and skills.
They used the phrase IR-driven success and cited a case study, a retail strip in Carmel, Indiana, where she apparently helped a client achieve a 20% IRR through smart buying and leasing.
A concrete example of results.
Yes, and mentioned her community involvement, suggesting deep local roots, then provided her contact info, caracondi.com, and her phone number.
Okay, it definitely positions her as a key player in that market with a focus on this metric. So pulling it all together, what's the big picture takeaway for our listeners about IRR and commercial real estate based on this guide?
I think the main thing is that IRR is an incredibly valuable, maybe even essential tool. It cuts through complexity by giving you a single annualized rate of return that accounts for all cash flows and the time value of money. That's powerful.
More sophisticated than the alternative.
Definitely. We saw how it's calculated, how it's used for evaluating deals, comparing options, making decisions. Its advantages are clear. But, and this is just as important, you have to respect its limitations. The reinvestment assumption, the sensitivity to projections, it's not a magic number.
Needs context and careful use.
Exactly. It should be used alongside other metrics and solid due diligence, ideally with guidance from someone who really understands the specific market, like the guide suggests Cara Conde does for Indianapolis.
Right. So for anyone investing or thinking about investing in commercial real estate, particularly in a market like Indianapolis, according to this source, understanding and using IRR seems critical, but doing so wisely, perhaps with expert help, is key to actually achieving your financial goals.
That sums it up perfectly. It's a tool to help you make smarter decisions.
So here's something to think about as we finish. How could applying IRR analysis change your approach to looking at potential real estate investments? And based on your own situation, your goals, your comfort with risk, what would your personal target IRR look like for an investment, say, in the Indianapolis market? Something to chew on. Thanks for tuning in to this deep dive.